The major concern over the Dodd-Frank Act is that it imposes a lot of cost on banks. And banks obviously are not willing, and I don't think they should be asked to incur the cost, the heavy costs that are imposed by Dodd-Frank. Every time we've had a banking crisis, we have ended up with more regulations, more regulatory agencies overseeing banks. I think we've moved in the wrong direction over time. So we looked at roughly 150 years of U.S. banking history. And we used all that data over a long period of time basically to try to determine what would be an appropriate leverage ratio or a ratio of capital to assets. And we determined that a 15% leverage ratio would not be inappropriate. And we think that's a better way to regulate banks. If a bank has, for example, $100 in assets, we're basically proposing that the owners should have $15 of their own money at risk. So if assets were to decline by $15, the only losses initially would be borne by the owners of the bank. We want to see the owners be the ones that have to lose more money if indeed they engage in excessively risky activities, rather than have taxpayers on the hook for bailing out banks if banks get into trouble.